Thank you for standing by, and welcome to the Columbia Banking System's third quarter 2023 earnings conference call. At this time, all participants are on a listen-only mode. After the speaker's presentations, there'll be a question-and-answer session. To ask a question at that time, please press star 11 on your telephone. As a reminder, today's call is being recorded. At this time, I'd like to introduce Jackie Boland, Investor Relations Director for Columbia, to begin the call.
Thank you, Valerie. Good afternoon, everyone. Thank you for joining us as we review our third quarter 2023 results, which we released shortly after the market closed today. The earnings release and corresponding presentation, which we will refer to during our remarks this afternoon, are available on our website at columbiabankingsystem.com. With me this afternoon are Clint Stein, President and CEO of Columbia Banking System, Chris Merrywell and Tory Nixon, the Presidents of Umpqua Bank, Ron Farnsworth, Chief Financial Officer, and Frank Namdar, Chief Credit Officer. After our prepared remarks, we will take your questions. During today's call, we will make forward-looking statements which are subject to risks and uncertainties and are intended to be covered by the safe harbor provision of federal securities law. For a list of factors that may cause actual results to differ materially from expectations, please refer to slide 2 of our earnings presentation, as well as the disclosures contained within our SEC filings. We will also reference non-GAAP financial measures alongside our discussion of GAAP results. We encourage you to review the GAAP to non-GAAP reconciliations provided in our earnings release and throughout the earnings presentation. I will now turn the call over to Clint.
Thanks, Jackie. Good afternoon, everyone. Columbia's third quarter results reflect our associates' emphasis on activities that generate business and drive efficiencies for our franchise. Our focus on balanced growth resulted in relationship-driven expansion in our loan portfolio and higher non-interest income. Despite industry headwinds, we continue to see stabilizing deposit trends. Integration activities are winding down as we are now in our 8th month since the merger closed. I'm pleased to report we achieved $140 million in annualized cost savings through quarter end, surpassing our originally announced target of $135 million. These savings are net of franchise reinvestment, which included investments in talent, products, technology, and strategic locations in de novo markets. While our formalized cost savings objectives related to the merger are coming to an end, our focus on efficient growth is not. We will continue to seek out offsets to our investments, driving our business forward in an efficient manner while enhancing shareholder value. Our talented associates, expanded footprint, and customer-focused business model provide us with the resources and opportunities to profitably grow market share throughout the West. Our future is bright, and I look forward to providing updates on these objectives in subsequent quarters. I'll now turn the call over to Ron.
Okay, thank you, Clint. And for those on the call who want to follow along, I will be referring to certain page numbers from the earnings presentation. Slide 4 lays out our Q3 performance ratios, noting stability in the NIM, our operating efficiency ratio at 52%, and our return on tangible common equity just over 20%. These are 5-quarter views, and recall we closed the combination at the end of February this year. Slide 5 shows our summary balance sheet, noting our $0.8 billion of deposit growth exceeded net loan growth, resulting in the loan-to-deposit ratio falling back to 89%. We also reduced our short-term Federal Home Loan Bank borrowings this quarter by $2.3 billion, which lowered our on-balance sheet interest-bearing cash position to $1.9 billion. On slide 6, we highlight the income statement trends. GAAP earnings were 65 cents per share, impacted by declining merger expense as we complete the integration along with fair value changes due to higher interest rates. On an operating basis, we earned 79 cents per share in Q3, about flat with Q2 as the increase in provision for loan loss was offset by declining non-interest expense as we realized cost synergies. Operating PPNR was up 6.5% to $259 million in Q3. Turn to slide 7, we break out Q3 GAAP earnings to help investors understand the non-operating and merger-related impacts on results. First column represents our Q3 GAAP fully combined results, with net income of $136 million, or 65 cents per diluted share, and return on tangible common equity of 17%. The second column includes our non-operating designation for income statement changes, again mostly related to fair value swings, along with $23 million of merger and exit and disposal costs included in non-interest expense, which are further detailed out in the appendix. These net to a $28 million reduction in Q3 earnings, resulting in the third column for operating income. And again, our operating income for Q3 was $164.3 million, or 79 cents per diluted share, with our return on assets at 1.2% and return on tangible common equity at 20.5%. We added pages to the appendix with trending on each of these columns. The discount accretion will be a steady and reliable source of interest income over time, as the majority is driven by rate, not credit, providing us with a steady build of capital over time. And recall, the CDI amortization does not impact tangible book value, so the 17 cents per share from merger accounting was the equivalent of 28 cents per share added to tangible book value in Q3. We'll continue to highlight and trend here to aid investors in valuing all earnings streams. And our tangible book value, excluding AOCI, increased 45 cents during the quarter to $17.48 per share. Moving to the next slide on section 9, we highlight net interest income and margin. Our NIM was steady from Q2 at 3.91%, resulting in $481 million of net interest income. The NIM excluding merger accounting was 3.28%. We reduced excess liquidity and cash late in Q3, which should have a positive effect on our NIM in Q4. Both measures were at the upper end of our prior guidance, driven by the increase in customer deposits this quarter. Slide 10 breaks out the repricing and maturity characteristics of the loan portfolio, noting 42% is fixed, 29% is floating, and 29% are adjustable. Slide 11 provides an updated view of our combined interest rate sensitivity under both ramp and shock scenarios. We've taken proactive measures to reduce the balance sheet sensitivity to a future declining rate environment. You can see here the trending over the past year where our rates down risk has been reduced significantly. And noted below, we calculate our cycle-to-date funding betas, which are calculated on a combined company basis over the periods presented for comparability. As of the third quarter, our interest-bearing deposit portfolio has priced in 37% of the Fed funds rate increases. Notable here is the cost of interest-bearing deposits, which was 2.01% for Q3 and 2.18% for the month of September. And again, the lift this quarter was influenced primarily by the additional broker deposits, which were used to pay off maturing Federal Home Loan Bank advances for a relatively neutral impact on our funding costs. The cost of interest-bearing liabilities was 2.77% for the month of September and 2.78% at September 30th, relatively in line with the 2.72% for the entire quarter. Slide 12 breaks out non-interest income items, noting we had continued growth in service charges and card-based fees due to higher revenue from customer-related products. The change in loans held at fair value at the bottom was a direct result of the increasing long-term yields this quarter. Next up on slide 13, we're happy to report we've exceeded our original cost synergy target of 12% or $135 million. As of quarter end, we've achieved $140 million in annualized go-forward cost synergies as we finalize our integration. We expect that will lift to $143 million by year end. And again, these amounts are net of reinvestments made in various areas. Normalizing the month of September expense, ex-CDI, was $81.3 million, which would be $245 million for the quarter, in the middle of our prior Q4 guidance range, which we reiterate at $240 to $250 million. Note on the right side is a waterfall from the prior quarter, with the reductions driven by lower comp, occupancy, and contract costs. To better help investors, given the combination accounting and moving parts on slide 14, we provide an updated outlook for 2023 on several key financial statement items. Our current outlook is consistent with last quarter's update, with the tighter band around the margin, as the third quarter's results came in at the upper end of guidance given favorable customer deposit flows. And moving ahead to the next section on the balance sheet, on slide 16, we detail out the investment portfolio. The table takes you from current par to amortized cost to fair value, noting the difference between current par and amortized cost is the combined net discount, which will be accreted to interest income over time. The decline in market value this quarter, of course, resulted from higher market yields across the curve. As you can tell, I'm excited about this portfolio as it gives us a significantly higher and stable earnings stream with greater optionality. The overall book yield was 3.61% with an effective duration of 5.7 as a quarter end. Slide 17 covers our liquidity, including deposit flows during the quarter. For comparability, we presented the table on the left as if we were combined for all periods presented. Total deposits increased $0.8 billion, or 1.9% in the third quarter. And customer accounts increased $89 million, and again, we used the brokered along with excess cash to fund a portion of the Home Loan Bank borrowing reduction. The upper right table details our off-balance sheet liquidity, with $12.2 billion available as of quarter end. And below that, we had cash and excess bond collateral not pledged for lines to arrive at total available liquidity of $19.1 billion. This represents 142% of uninsured deposits as of quarter end. Slide 18 provides the loan roll forwards, noting we sold $159 million of marked non-relationship resi loans in Q3. Our loan portfolio increased 3% on an annualized basis when this sale is excluded. Turning now to slide 19, we present the remaining balance of discount marks as compared to the prior quarter and at closing. For the AFS portfolio, the acquired discount was reduced $23 million via accretion to interest income. In our earnings release detail, we include this $23 million along with $19 million of higher bond interest income from the portfolio restructure we completed post-close to arrive at the $42 million total accretion for bonds. On the loan side, we had $29 million of rate accretion and $6.4 million for credit. The total marks declined $93 million in Q3 through a combination of accretion to interest income and the loan sale. And finally, in the back on slide 26, we highlight our regulatory capital position, noting our risk-based capital ratios increased roughly 25 basis points as expected in Q3. We expect to quickly approach our long-term capital targets of 12% on total risk-based capital, which will provide for enhanced flexibility to return excess capital to shareholders. And with that, I'll now turn the call over to Frank.
Thank you, Ron. Slides 20 through 22 provide select characteristics of our loan portfolio, including the composition of our commercial books and an overview of our office loans that highlights this diversified, granular portfolio primarily supported by properties located in suburban markets. Moving on, slide 23 displays our reserve coverage by loan category. Additionally, the remaining credit discount on loans provides a further 23 basis points of loss-absorbing capacity. The $37 million provision expense recorded in the quarter accounts for several factors, including shifts in the loan portfolio mix and trends in credit migration. The slight uptick in non-performing loans during the quarter suggests a move toward a more standard credit environment following a phase of exceptionally high quality. Slide 24 provides an overview of our consolidated credit trends. In general, our credit performance is and has remained positive, excluding the anticipated trend in FinPac charge-offs. FinPac charge-offs remained elevated during the third quarter, still centered in the trucking sector of the portfolio. However, the plateau in related early-stage delinquency trends we discussed on last quarter's call resulted in a reduction in FinPac net charge-offs, which react on a lag to delinquencies. Excluding FinPac, charge-off activity at the bank remains at a very low level. I'll now turn the call over to Chris.
Thank you, Frank. Turning to deposits, slide 25 highlights the quality of our granular deposit base. As Ron noted, customer deposit balances increased during the quarter despite the continued effects of market liquidity tightening and inflation. Our teams remain active in their markets, and their focus on customer acquisition and retention resulted in net deposit increases throughout many of our business lines. Strategic expansion also supports our business generation activities. We opened our first retail branch in Utah during the third quarter, supporting our intention to make businesses, their owners, their employees, and any others in the communities we serve throughout our 8-state western footprint. We also selectively added to our talented associate base, including the addition of 2 key bankers in Northern California, one in commercial and one in wealth management. We continue to capitalize on opportunities our expanded customer base provides and our commitment to our relationship-focused model. I'm pleased to announce our wealth management team had the best quarter in our company's history. We are positioned well throughout our markets to win business and drive balanced growth. I will now turn the call back over to Clint.
Thanks, Chris. Our regulatory capital position is outlined on slide 26. We remain above both well-capitalized and our internal threshold targets. And as Ron discussed, we expect capital to continue to accrete quickly in the coming quarters, providing us with ample flexibility for future shareholder return. This concludes our prepared comments. The team is now available to answer your questions. Valerie, please open the call for Q&A.
Thank you. Again, ladies and gentlemen, if you'd like to ask a question, please press star 11 on your telephone. Again, to ask a question, please press star 11. One moment for our first question. Our first question comes from the line of Jeff Rulis of D.A. Davidson. Your line is open.
Thanks. Good afternoon.
Hey, Jeff.
Wanted to kind of look at that margin guidance you've got for the full year. Looks like, to hit the low end of the 385 for the full year, you've got to be, looks like it's got to kind of really tank in the fourth quarter in terms of margin. What would, I guess, if you could kind of frame up the environment of how you hit the low end of the guidance for the full year on margin?
Jeff, this is Ron. Hey, good morning or good afternoon. That'd be similar to what we saw last quarter, right? So it depends on customer deposit flows. If we're on the upper, if we're positive on that front, we'll be on the upper end. If we're negative on that front, we'll be on the bottom end. Feel pretty good about that at the end of the quarter.
Okay. So again, all right. Seems pretty, well, I'll move on. On the credit side, just on the increase in non-performers, could we kind of break out what type that was in and perhaps where within the footprint?
It was really centered in 2 commercial accounts with the bank. Both of them had been struggling for quite some time, and one of them just decided to cease operations. And so, that one migrated into non-performing, and the balance of it is really associated with, in terms of non-performing assets, is a slight escalation in the 90-day plus in residential construction. They were, in terms of geography, they were located. One of them was located in Portland, kind of the Pearl District of Portland, and another one was located in California.
Okay, got it. And I guess the expectation, if we kind of track impact losses, like you said, kind of a lagging indicator on tied to delinquencies. Is that still the case, that we've seen that plateau, and if we follow delinquencies that continue to come down on that end?
It is still the case. I mean, I will say that, the third quarter, has a few holidays in it that impacts collection activity. Any impact to collection activity really hampers, obviously, reducing those past dues. And we had that in the third quarter. Had we not had that in the third quarter, we would have seen some further improvement. But that trend should continue, obviously, into the fourth quarter. Fourth quarter is usually another difficult one for collection activity, but we make sure that we're staffed up to handle it. So we feel we're continue to be on track.
Okay. one last one on the expense front. I don't know if it's possible to launch a 24 expense growth expectation. It's a big year of cleaning up, and you got a little extra on the cost savings on the deal in the fourth quarter. But if maybe not, if you can't point to a figure, just talk about kind of big picture. I think you kind of spoke to, Clint, sort of continuing to optimize is sort of the message. But any big picture sort of branch consolidation or larger investments that may come in 24?
Yeah. We're always looking at how can we become more efficient, and I do think that there's opportunities for us to do that, as we've already started. We're well into our 2024 planning process. So that's what I was alluding to there. We're going to continue to invest, especially in our de novo markets, and Chris and Tori have made some strategic hires in existing markets. Chris's prepared remarks, he mentioned California, Northern California. So we're going to continue to be opportunistic within legacy markets, but also invest in those newer markets and those high growth markets. But we're going to challenge ourselves to do that by finding offsets and efficiencies in other parts of our organization, as opposed to just simply letting expenses ramp up. In terms of kind of a launch point for modeling purposes, I'm gonna defer to Ron on that.
Yeah, and Jeff, we'll talk about that with an updated guide in January as we look into 24.
Okay, and just curious on the you said the cost saves are net of investment. Is there a ballpark number that you'd pass along in terms of what you think you invested against the cost saves of $140 million?
Hey, Jeff, this is Ron again. Yeah, it's actually a specific number, $21 million. So we've got gross of 164 and then down to 143.
Okay, great. Thank you.
Hey, Jeff, this is Chris, and to answer your question, you asked about branch consolidations. We have 5 left over from the original ones that we did, and when we look at our go forward, we're very pleased with our footprint. We think we're in a good spot with those, and don't anticipate anything further.
Thanks, Chris.
Thank you. One moment, please. Our next question comes from the line of David Feaster of Raymond James. Your line is open.
Hi, good afternoon, everybody.
Hi, David.
I was hoping maybe we could just touch on the funding side, and specifically focusing on the core funding side, exclusive of the broker deposit increases that we talked about earlier. I'm just curious what you're seeing there as we dig in. It sounds like core trends are stabilizing, that you're actually having some success attracting new clients, which may be difficult for us to see in some regards, just given clients utilizing excess liquidity. I'm just curious some of the underlying trends that you see there within your core deposit franchise, where you're seeing the most opportunity to drive core deposit growth and attract those new deposit clients, and how new core deposit pricing is trending.
David, hi, this is Tori Nixon. I'll talk a little bit on the commercial side of the house and let Chris kind of chime in on the consumer side of the house. For commercial banking, I mean, you're seeing just a few different things. One, folks are using excess cash to invest in their companies when and where appropriate, rather than borrow. So, the borrowing side is just less robust than it was a year ago. Folks are also kind of looking for yield where they can with any excess deposits. We have done, I think, a really nice job connecting with our existing customer base and just looking holistically at their relationship, and with that in mind, kind of focusing on where they may have funds at other places, and talking about bringing those funds to Umpqua Bank, and had a lot of success with that. That will continue without a doubt. We had a lot of success this quarter with it, and we've got a really nice pipeline as we kind of move into Q4. So, Chris?
Yeah, pretty much the same piece on that, David. I would add that on the new side, our rates are very competitive in the market, but where we're really seeing the opportunities to deepen relationships is in talking with the customers, taking them through our relationship model, asking questions about what else they have out there, and we continue to source deposits from other institutions. As well, the teams have, really kind of moved towards, there's still some minor integration, but not technology types of things, and our teams are out jointly calling together in all of our markets and winning new business just with their outward bound efforts.
Hey, Dave, it's Tory again. I thought I'd just add one more thing on there. One of the things kind of going on in our marketplace is tremendous disruption from other financial institutions, and we're looking. We've got it gives us a lot of opportunity, and so we're working hard in the markets that in our footprint to talk to anybody and everybody that we think fits the bank, and having some success with that.
Okay, that's great. And maybe stepping back a bit, it seems like we're going to be in a higher for longer environment for some time. I'm just curious, maybe, and look, I know it's still early, but I'm just curious how you think about maybe the margin trajectory and the business performance more broadly in a higher for longer environment, and how you're looking to manage the balance sheet and the business for that kind of environment.
Hey, Dave, this is Ron, and again, I'll come back to comments we talked about earlier. Do we see continued customer deposit growth? Then I'll feel really good about where we're at in a higher for longer environment. I think maybe in terms of 2024 specifically, we'll definitely give you an update on that in January at RG as we look into the year, but it's going to be the basic blocking and tackling. You heard Chris and Tory talk about continued customer deposit growth. We'll look good on that front.
Okay. And then last one from me. You guys have been accreting capital at a rapid pace. You're getting close to your 12% total risk-based target. I'm just curious, as you approach those targets, how do you think about capital management? Is there any interest in potentially returning capital maybe early next year, or at this point in the cycle, would you primarily be focused on capital preservation?
Well, I think, our focus is we always want to be good stewards of capital, and we have our long-term targets, and we've spoken about those and been very consistent with those. Even on a standalone pre-merger basis, our thoughts around capital levels were pretty consistent, and so essentially add 150 basis points to whatever the criteria is to be considered well capitalized, and that's our long-term target. Total risk-based capital has been the constraint. You mentioned the 12%. Absolutely, we're going to look at all capital deployment opportunities. I don't think that, as soon as we hit like 12.01 or something that we're going to look at a major shift. But, if we're creating 25, 30 bips of capital a quarter, it happens pretty quickly where then suddenly you're, 50, 75, 100 basis points over that target and still growing capital. We've mentioned that with our forecasts and expectations and the earnings power of this company, that there's not a level of what we think would be prudent organic growth that would absorb all of that capital. So by default, yes, we will be looking at capital return and how we do that as we manage those ratios. Now, I don't think you should expect it, next quarter necessarily, but I do expect that it will be a nice problem that we'll have as 2024 progresses.
Absolutely. Thanks for the call, everybody. Thanks.
Thank you.
Thank you. One moment for our next question. Our next question comes from the line of Timur Braziler of Wells Fargo. Your line is open.
Hi, good afternoon. For the broker deposits that were added during the quarter, can you just talk through kind of the timing during the quarter they were added, their costs, and then the expected duration?
Yeah, this is Ron. Good afternoon. That was later in the quarter, roughly 2 to 4 months in tenor. That's how we managed all of this from a wholesale standpoint, including the Home Loan Bank advances. And you're talking probably mid-fives in terms of cost.
Okay. And then I guess as you look at your borrowing position, where is that today relative to where you want it to be? And as that continues to mature, maybe just give us a schedule of how that matures and if the expectation is to replace that with additional brokered.
Yeah, and again, the Home Loan Bank advances are also in that 2 to 4 month tenor, so they're all repricing in that, call it mid-5 area as well. And that just gives us the most flexibility, right? And back to your second question, we're obviously sitting on more borrowing than we would like. It's in response to, of course, what's happened with just liquidity drain in the overall system over the past year. Ideally, over time, deposit growth continues to exceed loan growth. Customer deposit growth exceeds customer loan growth, and we're able to pay those down with the plan.
Okay, that's helpful. And, to the first question, it seems like the low end of the margin guide seems fairly conservative. And I'm just wondering, as we look at NII, is that also kind of 50-50 for an inflection point next quarter? Or even though there's some stability in the NIM, we could see another quarter of NII compression prior to that higher for longer really kicking in and benefiting the top line in 24?
Yeah, I mean, specific to that question in Q4 in the guide, if we're talking about material move, it's going to come down again to customer deposit growth. So I feel good about, you're not going to see a significant, you should not see a significant change in the net interest income dollars if we do have continued customer deposit growth in the fourth quarter.
Okay. Okay, and then the FinPac early stage plateauing last quarter, charge-offs still somewhat elevated this quarter, still focused on trucking. I guess, is that more of a cliff event where that pretty much subsides going forward, or is that going to be more of a tail where this lingers for a couple additional quarters prior to subsiding?
It's going to be a slow reduction over time, over multiple quarters, to my best estimation.
Okay, great. And then just last for me, the resi loans that were sold, about $159 million. What was the discount they were sold at, if you can provide that?
Yeah, the par value was in the 185 to 190 range, so discount was in ballpark 35.
Got it. Great. Thank you for the questions.
Yeah, thank you.
Thank you. One moment, please. Our next question comes from the line of Brody Preston of UBS. Your line is open.
Hey, good evening, everyone. How are you?
Good afternoon. Doing well.
Hey, I just wanted to follow up just on the loan waterfall chart, Ron. I just wanted to make sure I understand the 343 from payoffs or sales, the single-family sale, I think it was the 159 that's in there, and then the remainder of that is just payoffs, correct?
That's correct.
Okay. And then the 515 of prepayments, I just want to ask kind of like, what was the success rate in kind of maybe converting those into new originations this quarter?
Yeah, this is Tory, Brody. So let me just real quick on that. I think the success rate is very, very high. That's what we want to do. We had growth in the commercial side of on our C&I teams of about 40 or 50 million, and then growth in the CRE teams at about 180. So a lot of success in the rollover of that.
Okay, great. And then could I ask just a generic question about the loan portfolio? What portion of it is shared national credits? And then of that, what are you the lead on?
So our total commitments in the SNC portfolio is around $3 billion. Our outstandings are roughly $1.8 billion. We lead a couple deals today, but most of them are just a participation with ancillary business. And it is not a part of the organization that we are growing really at all. We have really strict guidelines of what we want to be in and what we're going to do, and obviously it's got to have significant ancillary business, including deposits. even consider.
Got it. Okay, thank you for that. And maybe just on the office portfolio, you give great detail there, but I was wondering if you happen to have what the ALLL for the office portfolio was.
Yeah, thanks for the question, Brody. We choose not to provide that much detail surrounding ACL on that portfolio. We feel that there's enough detailed information provided elsewhere for the group to really ascertain the quality of our loan portfolios, which is high, very good quality.
Okay, cool. And then I did want to ask, this was more of interest for me, just on the multifamily originations this quarter. I just noticed that there was like a big difference, I think, between the debt service coverage ratios that you had originated last quarter. I think they were like 1.7, and this quarter they were 1.32, and that's still healthy, but it was just a big difference, and so I just wanted to know if there was anything specific that kind of caused that.
Nothing specific, Brody. Without having that detail in front of me, it's hard for me to say. But what I would intimate from this is that we had extremely strong sponsorship on those deals, and they were relationship-based opportunities. So we had the banking relationship and knew the client.
Got it. And then I just had a couple last quick ones for you. Just on the non-accruals, I wanted to understand, was any of that included in the delinquencies? Just because when I looked at the buckets that you disclose on page 20, I noticed that the DQ rates had kind of moved higher for owner-occupied and C&I and mortgage, and then FinPac as well. I just wanted to make sure, was there any kind of overlap between the non-accrual moves and the DQ moves?
Explain DQ moves.
The delinquencies. So the mortgage went from 0.43 to 0.59. The C&I went from 0.3 to 0.6 on the total delinquencies. Owner-occupied from 0.23 to 0.51.
Yeah, that was primarily centered in a couple of loans, Brody.
Okay, were those the ones that you talked about earlier?
Correct.
Okay, and then this is my last one. On the one that you talked about earlier where they just decided to, or I guess you said they'd been struggling for a bit and then they ceased operations. What was the collateral that was backing, that specific loan? And I guess, how does the workout process evolve here, from when a business just decides to shut down? Kind of what do the steps look like?
That was an owner-occupied commercial real estate piece of collateral. What we do initially, obviously, is we downgrade it. We then get the property reappraised, which did come in, and I've said on these calls historically about our lending discipline and our aversion to leverage. Well, it played out in this case because we got the property reappraised. We still have equity in the property, and we continue to work with the borrower on trying to structure an orderly way out of this. We will not take a loss on this piece of property.
Awesome. That's fantastic to hear. I appreciate the detail. Thank you very much.